let's cut to the chase. What is going to happen in 2025? With the recent wildfires in Los Angeles, State Farm, insurance companies dropping policies, pulling out, interest rates still high, and inflation being sticky. What does this mean? Where are we at? And where are we going to go from here? That's what I want to go over with you today. And before I talk about where we are and where we're going, we need to dial back and look at how did we get here in the first place? Let's do a little bit of an education seminar on the real estate market and the macroeconomy of how we got here. Look at the big problems right now. California, there's not enough homes for sale. It's unaffordable. Everything's expensive now. But why is it still here? And why aren't they dropping the rates? Well, first things first. Let's dial it back to 2020, homes flying off the shelf. Everybody wants to buy a home. Everybody's buying cars, spending. Why was that? Because of the coronavirus. Remember, we thought the world was going to end in 2020. So what did the Federal Reserve do? They lowered interest rates. But why did they do that? Remember, we shut the entire world economy down, right? I didn't even know if I'm still going to be selling real estate right now in that hindsight. But this is what happened. When the economy shuts down, what happens? Gross domestic product of nations stops, right? So what does the government want? People to spend their money. So the interest rates, not to you and I, but what the Federal Reserve loans to the banks at, that's called the federal fund rate. And that was dropped to 0%. So in turn, banks can loan to consumers pretty much for free. And that's why we're seeing interest rates 2.3%. So what did that do? It stimulated spending, and people started spending like crazy. That's what drove home prices up. 2021, 2022, 2023. Let's look at the numbers. 2020, we had a record-breaking year. From December 2019, there were 5.64 million housing units sold in 2020. And that was 22% stronger than 2019. Look, I know homes seem expensive now, but what I'm trying to get at here is putting things into perspective. So we're gonna look at 2004. There were 1.6 million homes sold. After the crash in 2014, 647,000 homes sold in the US. 2021, 6.12. And 2022, 5 million homes were sold. So that's about 1 million less than 2021. Why did that happen? Interest rates went up. 2023, 4 million home units sold. And that was the start of the inflation crisis. And I knew this was gonna happen. With how cheap things got and how people were spending, what was remaining inventory, prices drove up because it's supply and demand. 2024, there was 4.06 million homes sold, right? So that's a slight increase from 2023. What are we gonna see this year? We gotta find out. But the biggest alarming thing that I wanted to see what's going on now is the California wildfires. With an already tight supply of homes in the market, now we have over 1,000 people displaced and new home buyers into the marketplace. Keep in mind, people lived there for a very long time. So they may be relocating to more affordable suburban communities, in turn driving up the prices. We've seen a lot of difficulty trying to close deals on homes right now, just the way it is with fires, insurance. So let's look at what are some of the opportunities we may see in 2025. Number one, assets. And this is what I want to tell you guys with the economy where we're at. The government has spent so much money in 2020 because interest rates don't go free for anything. They print money. This is called fiscal policy. When the government prints money, there's more money in circulation. And when there's more money in circulation, the value of it goes down. With more supply, it's less worth anything. And that's what we want to be playing with here. They're playing with a fine line between inflation and a recession. And eventually, we're going to get there. Just in December, the economy added 256,000 jobs to the labor market. Stock market and investors, they were expecting around 150,000 jobs. The issue is the Federal Reserve wants to keep interest rates high for a prolonged amount of time so people spend less money and there's less jobs. Inflation is the biggest culprit here that we're trying to prevent hyper runaway inflation. Look at Venezuela. Look at these countries, third world countries, that their economy is tanked because their currency is worth nothing. That's what we're running up against, right? Of course, it's the United States of America, but this is what the Federal Reserve is doing with their monetary policy in quantitative easing. Quantitative easing was developed in 2008 with the financial market crash, with money being pumped into the economy, put into people's pockets, people spend money, it drives jobs, products are developed, GDP goes up, you see? Now, this is the two key things you want to look at with the economy to see if we're going to be in a recession, right? Always look at the gross domestic product. If it's negative or if it's retracting for more than 2 consecutive quarters, that's early signs of a recession, and we haven't seen that yet. People think when you increase interest rates, when you bring back, dial things down, demand goes down, you think that when you stop inflation, prices go down. That's not the case. When you stop inflation, all you're doing is stopping prices from going up. So if you think that prices are going to go to where they were before, that's not going to be the case. If you're expecting prices to go down, that's going to be called a market crash. That's because there's a deflationary period in the market where people are not spending money, when people are losing jobs. And unfortunately, that's what the government needs to see in order for them to restrict and free up fiscal policy. So what should you do to protect your family, yourself, and your future self in 2025 against the threat of inflation, hyperinflation, and a runaway economy? So what's the big deal? Is this the last hurrah before a looming recession? Or are we missing something big? When you make rates low for long enough and people start spending for long enough, people's spending habits change fast. And I know for me, I started spending more money. Prices went up too. Cost of services, cost of products, cost of materials, cost of labor. Look, the Fed cannot ignore it anymore. With inflation going just above 8% in 2022, the Fed had to put the brake on, and they started hiking those interest rates. And in a matter of 6 months, interest rates went from 2% to 3% to 4% to as high as 7.9%. And that really put a halt on things. I'll look right here. In November 2nd, 2023, interest rates 30-year fixed rate got up to 7.76%. How long were the interest rates low for? The federal government loans to banks. Whatever the bank lends to you at for your 30-year fixed rate mortgage depends on what the banks can get their money for. That's called the federal fund rate. And starting in, July 2020, it was at 0%. For a total of 1 year, from April 2020 to April 2022, the federal fund rate was 0%. Then it shot up to 5.3%. And that's what paused the economy, what paused the buying, and it's remained there. Now, of course, we've seen a little bit of a dip in the interest rates. The federal fund rate in December of 24 was 4.4%. However, we may see an increase in the federal fund rate because inflation increased last month from 2.3% to 2.7%. Now, we know government's goal on inflation is 2%, and we were right there, but we pulled the plug a little bit too early. We got a little bit optimistic too early. So with this new administration coming in, we have to be very careful. And not we, but Jerome Powell has to be very careful on what they do with this monetary policy. Yes, things hurt. Yes, things are expensive. But do we want hyperinflation? That's what we're running up against. And I don't know where we're going to see the new presidency and how he's going to impact things. Yes, consumer confidence is going to be going up. Government spending is going to be going up. But we're going to see not the great meltdown, but what I call the great melt up. What do you have to do to protect yourself against this? When your dollar is worth 1/10 of what it used to cost. Because when the value of the dollar goes down, the cost of assets increase. Real tangible assets, companies, real estate, Bitcoin, gold. These are the things you need to put your money in. Because if you have your money sitting in an account and you're waiting for the crash, guys, it may take way longer than you expect. And you're sitting on 200 grand, that 200 grand in a couple of years is gonna turn to $90,000 of buying power. And that's exactly what happened in the last 3 years. So if you're sitting on the sidelines with cash, invest it. This is what you need to do. So let's look at some key points here. The great melt up is gonna start with one main area. With the current economic environment being driven by inflation and demand, which is expected to accelerate as the Federal Reserve shifts it to an easier monetary policy with the new administration. This is part of a larger, long-term cycle with two main phases. We're gonna have a pre-crisis, where we're at now, and then a post-crisis after the hyperinflation period. What's gonna happen is inflation will continue to rise, pushing prices up across the board. Groceries, medical bills, properties, cost of cars, it's all gonna continue to increase. And real estate, as inflation continues, property values will continue to increase, making it more and more important to own a home. Own some kind of asset. Either you're investing into S&P 500, into Bitcoin, make it more of a priority to put your money and park it somewhere. This is not an offensive play. This is more of a defensive play to protect your money, because we're gonna basically be hedging against inflation. We don't know how high it's gonna go eventually. So let's talk about strategies. Number one, always buy appreciating assets. Look at assets that appreciate as a forced savings account. A home is gonna appreciate from 4 to 6% a year. You're gonna lose money in the bank 6 to 8% a year. You see what I'm talking about here? So make sure to buy things like stock, S&P 500, Vanguard, EFTs, gold, Bitcoin. These are all valuable investments. And I'm not an investment advisor. These are just ideas that I want to give to you guys. And expect asset price volatility in the next coming years. We're going to see market fluctuations. We're going to see prices change, demand change. We're going to see pullbacks in the market. But don't look at this as a crash. These are buying opportunities. Just like in the seasonalities of the real estate market, buy when the demand is low. When you see the stock market crash, when you see it go down, put more money in. Because over time, we know that time and time again, nothing always stays down. This too shall pass. So buy when others are fearful and sell when others are greedy. Cash management. Guys, we need to get more and more cautious with your spending habits. Don't let that run away. With over 1/3 of the United States population, the lower 1/3 of the economic class has $0 saved in their accounts. With prices going up, people running out of money, and consumer debt increasing just like the government, this is a magical potion stirring up here for something that could be bad in the future. We're seeing credit card defaults rising, auto loan defaults rising. Now, we're looking at the 30-year fixed rate mortgage market, and we're not seeing any rise in defaults, but these are early indicators of what may come. I'm optimistic, and I'm gonna say that we're expecting people just to stop spending money, which will in turn slow inflation. It will slow inflation down, and we're gonna see the federal government get a little bit easier down the line. I don't expect a real estate market crash because delinquencies are so low and there's so much pent-up buyer demand. It's unbelievable. What's gonna drive the market if a crash does happen? Layoffs. If people start losing their jobs. So make sure to look out layoffs and delinquencies on mortgage notes. That's gonna be our biggest indicators. So let's look at some final advice here. You need to prioritize buying a home or investing in some type of asset that's gonna be appreciating. If possible, invest into stocks. If you don't have enough money to buy a home, we can talk about that. So if that wasn't enough, this inflation has started creeping up. Let's conclude. Mortgage rates nearly doubled since 2020. Can you believe it? I mean, you're thinking you can get a 3% and suddenly you're facing 6% or more? Talk about a shock to the system. However, perspective. Over the last 50 years, the average mortgage rate is 7.5%. So we're about national average. This shift, however, with the high prices and high cost of living, hit buyers and sellers hard. I've talked to so many people that are feeling the pinch. I'm feeling it too. 100 grand income doesn't do what it used to do. It doesn't, and it's sad to say. Take Sarah, for example. She bought her home at the peak of the market in 2021. And now she's looking back and seeing what a great deal she got. Even though it was a 3.9% interest rate, she's happy. And she told me, now my neighbor's house is worth less than mine, and I'm stuck this huge mortgage. But on the flip side, I met John last week, and he's been saving up for years, and he's finally ready to buy. Now he's facing sky-high rates. He says, I feel like I missed the boat. I can afford the down payment, but the monthly payments are killing me. And it's not just for individual buyers feeling the heat. Overall market has been taking a hit. We see fewer transactions, homes sitting on the market for longer, and in some cases, prices are starting to soften a bit. Now, if you start to see price drops in the marketplace, that doesn't mean the market's crashing. That means that the market is correcting to where the demand is, right? And a lot of the sellers in the marketplace are still stuck in the previous market because agents don't know how to communicate the market effectively to the homeowners. So when you're looking at things, it's about the market and interpreting the market data. So what do we see for 2025? The California Association of Realtors is predicting a tiny increase in the US GDP for the next year, talking just under 1%. So 2025 may remain nominal and not much unchanged from 2024. Now we may see increase in consumer confidence with the new administration coming in. So the 2025 market is going to be driven by consumer confidence and demand. But it's going to be very tricky in how this president is going to say things, because we remember in the last time he was president, he would say one thing and the market would react. So that's going to be the same case here. There's going to be a lot of areas to profit off of, and you have to be very careful. So consult with professionals and advisors to guide you to where you need to go. Stay on top of local market conditions. Keep an eye on those indicators. I'm going to be watching this every day. If you guys want to be updated and in the loop, I post monthly and weekly emails wrapping up every week and every month of the local and macro economy. So if you want more, feel free to DM me or put a message inside of the comments below, put your email so we can add you to the list. Diversify your investments. Real estate's always about location and always about being ready to adapt when the market is going to throw you a curveball.